How to analyze a stock in under 10 minutes. Most people will tell you stock analysis is complicated. They're wrong. In the next 10 minutes, I'm going to show you the exact framework I use that takes under 500 seconds. And here's the part that shocks people. You don't need a finance degree. You just need to know where to look. Let me prove this works. Part 1. The 60SECOND Foundation. Every single stock comes down to one question. Is this company worth the price? That's it. That's the entire game. Start here. Look up the stock's P/E ratio. That's price to earnings. You'll find this on any platform. Fidelity, Robinhood, Yahoo Finance. Wherever you check stocks, the P/E tells you how many dollars investors are paying for every dollar of profit the company makes. Here's what matters. The average S&P 500 company trades around a P/E of 20. A tech stock might sit at 35. A boring utility company might be at 12. If you see a P/E of 50 and it's not a hot growth stock, that's a red flag. You're paying a lot for those earnings. Let's say you're looking at Apple. Right now Apple's trading with a P/E around 28. Compare that to the market average and to its competitors. Is it expensive? Slightly. Is it crazy expensive? No. That tells you something. Now check the company's revenue growth. Pull up their latest quarter earnings report. Is revenue going up year over year? By how much? 15%? 30%? Or is it flat? This matters because a high P/E makes sense if revenue is exploding. A high P/E on stagnant revenue? That's when you walk away. Part 2. The competitive edge test. Now ask yourself, why would someone buy from this company instead of the competitor? This is called competitive advantage, or moat in investor speak. Does this company have pricing power? Can they raise prices without losing customers? That's huge. Microsoft? They have a moat. Everyone relies on their software. Schools teach Excel and Word. Businesses run on Microsoft. They can charge premium prices. Generic grocery stores? No moat. They compete on price and location. That's much weaker. Look at repeat customer rates. Look at whether customers actually need this or are just buying because it's convenient. Look at whether the company has patents or exclusive technology. For consumer stocks, like Nike or Starbucks, check if people actually prefer the brand. This takes 2 minutes. Read 5 customer reviews on Reddit about the product. Not fake reviews on the website. Real conversations. If people are loyal and willing to pay premium prices, the company can sustain higher profit margins. And higher margins mean better long-term returns. Part 3. The financial health check. Before you invest a single dollar, you need to know, is this company drowning in debt? Pull up their balance sheet. Look for total debt. Then look at their cash on hand. If debt is way higher than cash, you're holding a risky position. Let's use real numbers. Imagine Company X has 50 billion in debt but only 5 billion in cash. That's a problem. When the economy gets tough, they're vulnerable. But imagine Company Y has 20 billion in debt and 15 billion in cash. That's totally manageable. Here's the shortcut. Just look at the debt to equity ratio. Most platforms show it. If it's over 2, be careful. If it's below 1, they're in solid shape. Next, look at something called free cash flow. This is the cash the company actually generates after paying for operations and equipment. This matters more than reported earnings because you can't fake cash flow. If free cash flow is going up, that's a green light. If it's going down while earnings look great, that's suspicious. The quick checklist. So here's your under 10-minute framework. Go through this every single time. 1. Check the P/E ratio. Compare it to the industry average. 2. Look at revenue growth. At least 10% year over year is good. 3. Identify the competitive advantage. Why do customers stay? 4. Review debt to equity ratio. Keep it under 2. 5. Confirm free cash flow is positive and growing. That's it. 5 steps. You just analyzed a stock in 8 minutes. Will you get every stock pick perfect? No. But using this framework puts you ahead of 90% of casual investors. This is exactly how I analyze before adding anything to my Roth IRA or taxable brokerage account. And here's what's wild. Once you practice this 3 or 4 times, it becomes automatic. You'll spot a good stock in 5 minutes. If you're serious about building real wealth through stocks, you need to know how to analyze them yourself. You can't rely on tips from friends or financial TikTok. This framework is your foundation. If this helped you understand how to actually evaluate stocks, hit subscribe. I break down personal finance strategies every single week designed for people actually trying to build wealth. Thanks for watching.